Hi, I am Lisa Lede Davis, owner of Kennesaw CPA. I've had the pleasure of working with the Small Business Summit for several years now. One of the reasons we work with the Small Business Summit is that our focus, like theirs, is helping business owners like you. We focus on the financial side of the business, so our goal is to help you get the most financial reward out of your business or startup if your business hasn't started yet through effective tax planning, budgeting, cash flow, just all things financial that goes along with your business. It's just being that trusted financial advisor to yourself, to your business as a business owner. Today, I want to actually walk through a financial report that's key to business financial planning or into you as a business owner, and that's your cash flow projection. One of the reasons we're focusing on the cash flow projection today is that, as we all know, the pandemic has come with its own special challenges, and especially for small businesses. It's also opened up some windows of opportunity. So, for those businesses that can weather the storm and hopefully move from just surviving COVID 19 to thriving into and beyond COVID 19, because we do think this will end, our goal is to help you find the right financial tools and not only help you find those tools, but help you implement those into your business so you have a greater chance of success for your business. So I'm going to just start off with walking you through a sample cash flow statements. We're actually going to go through two of those. As a business owner, this is something, if you have an existing business, you want to use as a projection. You can use it to also see where your business cash went when you're looking at it for operations that's already happened. But if you're trying to project into future years, it's a great planning tool to help you as a business owner see what your business is going to need in the future as far as cash flow needs. See how much money you can take out of the business when you determine what those cash flow needs are. So it can help determine your distributions, any additional cash flow you may need, that sort of thing. So again, I'm going to start off by pulling up and sharing this sample cash flow statement. So this is the summary sheet for the scenario, but we're going to actually start off by going into the detail of the cash flow statement. Now, we're starting off by looking at more of a service-based business than a product-based business, but we're going to talk about the differences between the two as we go. So we can see with our cash flow statement, this is just a cash flow statement that is modeled in Excel. So it's something that most business owners, if you're familiar with Excel, you can use fairly easily. Ours, we use formulas because we find that more efficient as to use as the factors may change. But you can see this first row, we start off with our cash on hand. And this is cash on hand at the beginning of the month before the operations get started for that month. So see, we're in January 2021. We're starting off with $10,000 in cash that's in the business. Say it's an existing business, we've taken out everything but 10, or if it is a new startup, this is what we're investing into the business, $10,000. Each month, you will see that cash either grow or decline based on the projections that you do on your cash flow statement. So in our service-based business, we're starting off with billable hours because, say, we're professional services. Our sales is generated by the hours we can bill to a client. So we're starting with billable hour. And here in yellow in our cash flow statements, you'll see a few items that's highlighted in yellow. Those are what's considered our key items. So here is the assumptions that we're making. One, we're service-based. This is for a service-based business, so you know that wouldn't be an assumption if it was your existing business. Two, that we're going to experience moderate growth, 5% month over month, which adds up to a significant growth for the year end. But this is more business that's scaling. So some moderate growth and on-demand staffing. That's a key assumption because on-demand staffing means that I bring in the resources as I need it. So I don't have a set staff where there's a payroll I have to make sure that I can cover each month. The resources are used as the hours are needed to bill or to service a client. It's probably not feasible for most businesses to have on-demand staffing, but that's what we're going to look at in this scenario. And the second scenario, we're going to look at a business that has a fixed staff that they have to fund or provide for. So we're going to start off with the receipts portion of our cash flow statement. That's the money that's coming in. So in this scenario, what we have coming in is only the sales. So if we're projecting 149 billable hours at $95 a an hour rate, we should be bringing in 14,155 for the month of January. That is the only inflow that we have in. We have no other loans that we're taking out. There's no other owner investments that we're putting in. So we're bringing in 14.5. Our payroll with billing as BUs at 80%. So when you do have payroll, it's especially when you have staff, it may not be feasible to expect that dot for every hour a staff member spends in your office working in your business, that's going to be billable to a client. Usually it's billable at some certain percentage. If you had a full-time person, maybe 80% of their time is billable, or even part-time, or maybe it's 75%, or maybe it's 90%. Rarely is it full 100% because there's always going to be some time needed for training, overheads, and things like that. So in our scenario, that's an important assumption we made. We made an 80% billable. That means we still have to pay for the other 20% of their time, but 80% goes to billable. So in here, our cost of goods sold as a service-based business is based on our payroll. So that's the main cost that goes into delivering our service. If you were a product-based business, your main cost would be the cost to produce your product. So that may be the cost of, if you're just doing retail, maybe that may be the cost of purchasing the product, having it shipped to you, and then you in turn offering it to your client. However, if you're producing your own product, your cost of goods sold may be a combination of labor and the cost of the items that go into producing that product. What's key for you as a business owner, even if you're a one-man show and you're working in your own business, you want to factor in the cost for payroll and the cost for labor, even if that payroll and labor is your time and you're not paying yourself. Because if you're going to scale your business or grow your business, you need to know what it costs you to bring in someone like you to do the work that needs to be done. Or maybe it's someone that's just skilled at just doing that particular thing and they don't have to do all that you do, but you want to know the cost associated with that, because at some point you want to fund a payroll for yourself as well as grow and maybe have other people working in your businesses so your business can continue to grow. And to do that, you need to assure that you're charging not only the correct rate that can make have your business profitable, pay payroll, cover overhead. Another factor about payroll is you want to build at anywhere from 2 to 3 times your base payroll costs. So if you have someone, say you're in professional services and you're providing a service and you have to pay your employee $25 an hour, well, you want to make sure that you can bill them out based on what the market will the market accept and what's the industry standard for your industry. Can you bill out at 2.5 to 3 times that payroll? So if you're paying $25 an hour, you want to make sure you're billing out at least $60 to $75 an hour. And why is to cover the cost of not only your payroll, the overheads associated with your payroll, as well as all of your operational expenses. So that's why you'll see a billable rate that is significantly different than what you're paying your employees or what you would pay your employees. So even if it's for yourself, develop a billable rate for yourself based on what it will cost for you to pay someone to do that job. And then we want to look at key costs like payroll overhead. So when you have payroll as a business owner, you have, if your employees are W-2 employees and not 1099 contractors. So if they were 1099 contractors, you actually only have the cost of that 1099 contractor. And you can build that out at 2 to 2.5 times because you don't have the overhead that's associated with payroll. If you have W-2 employees in payroll, you want to make sure that you account for the fact that you're going to have to pay payroll overhead taxes. That is Social Security, Medicare, unemployment tax, as well as having workers' comp. So those taxes just alone without the workers' comp might be 11%. Then you add in workers' comp and the fact that if you want to retain staff, if they're full-time, you might have to offer certain benefits. So you should project your overheads anywhere between 11 to 25 to even sometimes 30%, depending on the taxes and the benefits that you're offering. If you're not going to offer benefits, you're probably safe doing somewhere between 11 maybe 12% overheads. But if you want to have things like benefits offered to your employees to encourage them to stay, maybe a retirement account, you want to go as high as 25 to 30% on top of your payroll. And again, this is a factor of your payroll. And then you have other operational expenses that you're trying to cover, like advertising, marketing, IT services, rent, supplies, website, utilities, just all the thing that goes into operating your business. So in this scenario that we're talking about, we had, again, our payroll plus our billable hourly rates, that's 14,000 coming in per month. Our expenses are only averaging around 11,000 a month to start. You know, it grows as our revenue grows, because some of these expenses will be fixed each month. Some of them are going to be a factor of revenue. So it's going to grow each month as the revenue grows. So another key expense that we have in here is our point of sale system, which is our credit card processing. With a lot of us providing services virtually and a lot of clients wanting to be able to obtain those services virtually, they also want to make sure they can pay virtually. And so making sure that you set up credit card processing for your clients to be able to pay you. They may still be able to pay you by check, especially if you're invoicing, say, through QuickBooks. You can give an option for the clients to pay directly from their bank account, or they can pay by credit card. If they do pay by credit card, of course, you have to set up a merchant account with like a Square or a Stripe, or you can even do it through QuickBooks. But you set up a merchant account to be able to accept credit card payments, and that merchant account is going to charge you credit card processing fees anywhere from about, I say 2.5, 2.6 to 3%, depending on who you use and all that goes into it and the volume that you process. So you want to factor that into your operational expenses. In this scenario, we are projecting that credit card processing fees or all of our sales will be processed via credit card. So that will be the only option that we offer for payment for our clients. There will be a 3% processing fee attached to all of our revenue. So we have to account for that expense going through our business. And that can go into cost of goods sold as well, because it's actually the cost to produce that revenue. So again, if we look at our cash inflow that's coming in, our cash outflow that's going out each month. And so depending on how comfortable you are working in Excel, for us, it's a lot of formulas. So I have hours based on hours. If those hours change and I change it here, it changes all the numbers because it's a factor of that. And actually, I'm in the second scenario. Let me go back to the first scenario. So the first scenario, our actual cash inflow exceeds our outflow each month. So you'll see that in the cash flow statement. You'll have your outflow, your inflows, and then you'll have your net cash in or net cash out. We can see each month we have positive net cash in. That means our revenue is exceeding our expenses. And year to date, our positive cash flow is $54,690 per year for this year. But our cash in the bank is $64,691 because we started with a $10,000 investment into our company. So we have that as our first scenario. And again, when you develop these cash flow projections, you want to be sure to be somewhat conservative. And when you're using a cash flow projection as a planning tool, you might end up setting the base, but doing 3 or 4 different scenarios based on your business. So you have your sales projections, which is key to all of this. Everything is based on basically a factor of sales. So if your sales projections is too high, this is going to overstate your cash flow for the year, and it may not identify where you have cash flow needs. So you want to make sure your sales projections are somewhat conservative. Maybe you do 3 scenarios. Maybe you do ideal sales. What happens if I can only sell 75% of what I plan? Or what happens if I have a situation like where we're in now with a pandemic? Maybe I can only go 50% of the sales of what I plan. This cash flow projection is going to tell you what the cash flow needs are for your business based on that. Also in this projection, we just had the owner of this business start off with $10,000 cash of their own money. If the owner had to borrow money to invest in their business, say they needed a larger amount, they would then have interest expense associated with that loan to invest into their business. So there would be interest expense. And then below the line, because interest expense is deductible, so you want to have it in your operational costs. but below the line, you would also have the loan principal payment. So for instance, if you had a $25,000 loan and maybe your payment's $500 per month and $400 of it is going to interest, you'll have $400 in interest expense and then $100 in loan principal payments to show the fact that $500 per month is coming out to repay the loan. And you see the impact of that on your cash flow statement. So quickly, we're going to look at scenario number 2. Scenario number 2 assumes the same type of business, except there's a couple of key changes to the assumptions. One is that you're working with fixed staffing. So you don't have on-demand staff that as your business grows, you can just get the resources you need. Your staffing is fixed, which means you have a payroll to cover each month, regardless of what your sales volume is. So here we start off with lighter sales, maybe 75 hours a month, but growing at a more aggressive rate at 10% over month. So this is a business that's maybe starting up. They start out with maybe 1 or 2 contracts, but they're aggressively growing those contracts each month. They may be doing that into some direct marketing or just relationships, but that's the scenario here. Now here with the sales, we still have our same hourly rate. So our sales at 75 hours for the first month, you're bringing in about $7,000 per month. You start off with $10,000 in cash, so your cash available at the end of the month is about $17,000 before your expenses. But we're on a fixed payroll because, when you find the right team, you want to make sure you plan to be able to retain that. So to retain it, you've got to be able to make sure you can cover payroll each month. So we have a fixed team to provide these services. We know with this team, you want to know with your team, what's your maximum sales that you can get before you have to expand your team. So you want to look at what your available billable hours is going to be with that team before you're going to have to expand. Here in our scenario, we're showing that we can keep the same team from the beginning of the year to the end of the year. And because by year end, we're only billing about 1,600 hours, we believe we can get that 1,600 hours billed with the same team that's in place. So we have fixed payroll that has to be covered each month. We have the same payroll and overheads and benefits that we talked about before. And then other operational expenses like advertising, marketing, rent. You have supplies. There may be certain times of the year. Supplies may vary where you have to buy a larger piece of equipment. You want to make sure you put that in the scenario so you can plan for it. We have things like website maintenance, utilities, telephone. Every business will be different, but you should be able to look at your historical expenses or your planned expenses and then project what those expenses are going to be each month. So in this scenario that we're talking about, our revenue is not sufficient enough to cover our expenses. So each month we have cash flow coming in, which we show here as a factor of our service hours that we're selling plus our billable rate. So we have 7,000 coming in for the first month, but because we have fixed payroll and lots of fixed operational costs, what's needed every month is 13,629. So in the first month, our business has a deficit. And as you can see, even as our revenue grows, though the deficit gets smaller, the business continues to have a deficit until about July. In August, you can see that business is starting to cash flow and will positive cash flow between August and the end of the year, which causes a $16,000 outflow for the year, which is with your $10,000 investment, which is a negative $6,000 in cash for the year. What you're not trying to cash flow is the $16,000. What you're trying to cash flow is the highest deficit month that you have in the year on your cash flow planning, not what the deficit is at the end of the year. So here, highlighted in yellow, our highest deficit cash flow month is the month of July. So we know we're trying to cover $21,000. So even with the $10,000 that we started with, we will still reach a $21,000 deficit by the month of July. We would have to have those additional dollars in place for this business to cash flow, for us to retain our same payroll and expenses. So in order to do that, either you're going to have to invest additional dollars as an owner, or you're going to have to get some capital from other outside investors or a debt capital to invest into your business And then you would continue this projection on until the following year to see when that business is able to pay back all of its debt or investments and to strongly exist in just cash flow on its own. So that's why we went through two different scenarios to talk about a business that cash flows, a business, and these are the summaries on that, a business that does not cash flow. Again, we're not focusing on just what the deficit is at the end of the year. We want to look at that deficit at the highest point of the year, which should highlight the specific month. And then again, one of the reasons we talk about cash flow as being one of those key statements is it helps you make so many different decisions as a business owner in your business. Maybe your business is an existing business and you want to know when's a good time, my business is profitable, it has cash flow, can I take out money as a business owner? This will let you know what you can take out, how much you may want to leave within your business to continue to cash flow operations. If you're a startup business, how much capital you may need for your business to survive through those projections. Do you need to invest more dollars? Do you need to get debt to put into your business? Just answering all those questions for you as a business owner. So although there's plenty of financial statements as a business owner, as you know, there's your profit and loss, there's your balance sheet. The cash flow statement kind of acts as a combination of all those things, but it's taking your cash at a point in time and how it changes over time in a 12-month period. So this is one of the reasons why we wanted to share that with you today, kind of walk you through a couple different scenarios and encourage you for your business and for COVID-19 to continue to work with those things, continue to plan, to work with your trusted advisors, to use those financial reports. Thank you all for joining us. And of course, if you have any questions, you can always reach out to J.R. McNair. I can be reached at lisa.davis@kenesawcpa.com. We'd be happy to answer any questions, share information, and hopefully you guys have a great time.